Hello everyone. In this video, we will look at what market auction zones are and what types exist. Market auction zones often serve as price reversal points due to a surge in counter volume in the market. These zones are characterized by a high concentration of buy or sell orders and can serve as points of interest or targets for our positions. They are divided into two types. The first type is liquidity zones, which are fractal lows and highs, equal lows and highs, as well as liquidity pools. The second type is inefficiency zones, which include all three of our volume tools. You can find more details about this in the previous video. However, I want to emphasize the tools that provide the greatest amount of liquidity to the market. These are the fair value gap and the volume gap. Now let's examine everything in more detail. The first example is ordinary fractals behind which market participants' stop losses are located. It doesn't matter to us whose stop loss it is, whether it's a retail traders or a large hedge funds. We should understand that behind fractal lows, there is sell-side liquidity, or in other words, sell orders, while behind fractal highs, there is buy-side liquidity, which means buy orders. The general rule here is that the higher the time frame on which the fractal is formed, the greater its potential influence on the market in the context of liquidity raid. The second example is equal lows and highs. This pattern is used in classic analysis and is known as a double top or double bottom. According to classic analysis, it is a reversal pattern, suggesting opening a position in the opposite direction after it forms. However, we view equal lows and equal highs as a cluster of buy or sell orders, acting as a magnet for price and serving as an excellent zone where a large volume of liquidity can enter the market. And the third example is liquidity pools. This refers to a market movement characterized by low volumes and the formation of liquidity on one or both sides. This type of movement is often found in market consolidation phases or before significant news releases. The price deliberately creates these liquidity pools to serve as fuel for the future when they are raided. But there's a small nuance. Depending on the type of movement, whether it's a retracement or trend-following movement, the liquidity pools differ. In our case, we're interested in liquidity pools that act as reversal points and form along the trend. Schematically, it looks like this. The price moves impulsively with the trend, and at some point market volumes decrease, forming trend-based liquidity, which is then swept, causing the price to reverse and continue onward. The second type of market auction zones is inefficiencies. Here, the primary volume comes from unfilled orders by large players, as opposed to liquidity zones, where the main source of volume is traders' stop losses. Of course, all inefficiency zones can provide market volume, which includes order blocks and rejection blocks, but the main ones are the fair value gap and the volume gap. The principle of their operation is quite similar, but there are some differences. First example is the fair value gap. This is a price range where one side dominated, and the price wasn't offered evenly to both buyers and sellers. The primary source of liquidity comes from unfulfilled orders on one side or the other. As a result, the price often returns to these zones to rebalance inefficiencies and to get new volume. The second example is the volume gap, which follows a similar logic to the fair value gap, but forms because the price at market close doesn't match the price when trading starts. This creates a gap in price where no market activity took place. This can happen due to political or economic events over the weekend when the exchange is closed. It most commonly occurs in Forex and commodity markets. I hope this video was informative and useful for you. Don't forget to subscribe to the channel, like the video, and leave a comment. See you later.